The Institute of Economic Affairs in Ghana is asking the Monetary Policy Committee of the Bank of Ghana to further increase the monetary policy rate to 19%. The proposed increment will be a 200 basis point rise in the current policy rate of 17% and comes as the committee prepares to announce its decision on Monday, May 23rd. The MPR, monetary policy rate at which the central bank borrows, lends to commercial banks, is also an inflation targeting tool to control the increase in the price of goods and services. Joining us to discuss further, Omosuyi Temitope, who is an investment strategy analyst with AFRINVEST Asset Management Limited. Omosuyi, good morning. Thank you so much for joining us.
Thank you, Reuters.
Let's talk MPRs and central bank decisions. What do you make of first of all, the producer price inflation figure in Ghana at 31%? What is that? What's your read on that kind of figure?
Well, it's actually very scary. Same with, a number of other countries. Because if you look at 31% compared to even policy rate at 14%, the real gap is wide. That's on the one hand. This is just producers' price index. It's looking at, prices in terms of what producers, in terms of their sales, their input. So it's a bit different from CPI because CPI is looking at it from the angle of consumer, right? And the difference is just from the tax. For consumer, price index, VAT, and all of those would have been added to the components, while for producer, it's just about the input and the selling price. So when you look at these two numbers, in addition to what you said, the PPI, even the CPI went up significantly, in fact, to about 21% from 19%. And you know why that is actually very scary? On month, that's where you are able to identify price pressure. For instance, the CPI went up on month-on-month basis by 5%. Man, if you analyze that, or if you annualize, if you analyze it, it's just like, how many months do we have left in this year? You multiply by that number, that means you have about additional 40% to the current level of inflation. So 40 plus 20. So if care is not taken, before the end of the year, Ghana is looking at over 50% inflation rate, and the policy rate is still around 14%.
Wow.
And you're talking about, so it's a holistic problem because it's coming from both producer and consumer. And, the reasons are not far-fetched, right? We look at what is happening globally, and in terms of energy prices, it's taking a toll on manufacturers, and they have to pass this to consumer. And in fact, in terms of even energy, fuel to even, for vehicle and household consumption. That's also a problem. And it's also very instructive to know that, the currency, Ghana cedi has even depreciated so far this year by over 25%.
Ouch.
That has added to imported inflation. Manufacturers are not spared, so no one is spared in the economy. So which is why the current policy is very important to actually analyze all of these things, because factors driving inflation now across countries are very complex. They are not just endogenous. They are not just within the country.
Exogenous.
They are exogenous.
Yeah.
So there's limit to what monetary policy can do. Although I've always said that domestic factors are also important, because in most of these countries, too much money are still chasing few goods.
Gotcha. Thank you for that. So the IEA, that's asking the Bank of Ghana's Monetary Policy Committee to hike again, because I think they hiked to 17, now they're telling them to hike to 19. You already said that monetary policy can't really do everything. So this rate hike that they're pushing for, what is it going to do? Well,
I think what the Research Institute actually said is quite inclusive. They proposed that policy rate should be increased. It has to also be accompanied with increase in food supply.
Yeah.
They also encourage that government should put even subsidy on transport, not fuel, transport. So that is what people actually consume, the end. So, in a way that has actually disaggregated or differentiated the economy. A rich man would not want to take public transport. An average person would want to do that. So in a way, it will cushion the impact of, of the policy on people. So really, like I said, if you are looking at, PPI getting to over 50%, CPI, the same thing, that's quite scary. And monetary policy rate is just about 70%. The last increase was about 250 basis points. And even some analysts, when I saw that, I was laughing, because some said they front-loaded. You can't front-load. They have not even front-loaded if you are looking at in the last 3 months, month-on-month inflation has been increasing by an average of 4%.
Wow.
So that is quite significant. So the Monetary Policy Authority would want to do something in that regard. Why is it very important? If you look at most economists, what is driving inflation are 3 factors. 1, money supply. 2, exchange rate. 3, structural shocks, which will come from these, external factors and all that. Money supply increased during COVID-19 because so many countries supported their economies through, government support, household spending, and this was not, followed by increase in domestic productivity. In fact, a number of these, countries supported, Ghana is not excluded, they supported the economy beyond the negative output gap created by the pandemic. That is, the gap needed for maybe by the economy is just about $1 billion, but government supported by 3 trillion, 4 trillion above that. So the concept, the monetary policy, tool are still effective, although to a certain extent they cannot just afford to leave, things like that. They have to work on the money supply. And I also talk about exchange rate. Why do they need to increase interest rate to also address exchange rate? Because it has pass-through effect on inflation. Once you increase, interest rate, because policy rates are rising in advanced economies, right? So it means in terms of the interest rate parity, you have to adjust. Right. You have to adjust. And again, these countries also need foreign direct or foreign portfolio investment. At least you need something. You don't necessarily have to, attract foreign direct investment just now. I think you need something to just show up your reserves. Yeah. So they will want to actually increase rate because, in fact, this popular valuation man, Darren mentioned that risk premium in emerging markets has risen significantly, which means, for you to compensate for that, for any country, you have to increase interest rate. Gotcha. And again, interest rate is also very important because you have to, it will affect current account balance. Because, I mentioned that the currency is suffering significantly. All of those are having a fallout of the current account balance. In fact, the last time Ghana saw a positive current account balance, I think it was in 2010 or so. Currently, it has gone down, it has worsened significantly, over 600 million, in terms of current account deficit. So that is a clear picture that, inflation will continue to stay high. Exchange rate pressure will be there if policy rate is not increased. The only thing is for government to now begin to look at the impact. How do we mitigate the impact by, as suggested by the research, the EIA research, you have to ensure food supply. For some countries, what is affecting inflation is just beyond the money supply. When we talk about increase in interest rate, the attention is how it will stifle liquidity in the system. But for some countries, that what is affecting food production and all that is just beyond money supply. In fact, it's beyond local money supply, your local currency. Increase in interest rate will only increase reduce local currency in the economy. For instance, countries are exposed to the problem in Russia and Ukraine with supply. So how do you use local currency to address that? So in fact, when you maintain a dovish stance, you are only creating more problem because people will have more local currency against the little greenback you have. Now speculates. So I think it's actually very important for the monetary policy authority in Ghana to look at how to address those challenges.
Brilliant. Bring Bob and Nigeria. Next week is huge. So Ghana next week, also Nigeria. What's the factors for Nigeria? What do you think Nigeria is going to do as far as the MPC is concerned?
So when you look at the prevailing macroeconomic condition, you don't even need any detailed analysis or any form of engineering to know that it is time the MPC increased the MPR. At the March meeting, they noted a number of factors. When the meeting was held, inflation was just 15.7%. Now we are looking at 16.8%. In fact, they were quite optimistic that inflation will moderate. It's more like they were taking the stance of J. Powell when he thought inflation was transitory. So now, here we have today 1.7% increase on month-on-month. That is huge. That is huge because whenever inflation in Nigeria exceeds 1% on month-on-month, just know that there's a significant pressure because currently because of the 1.7% increase. In fact, this year month-on-month in terms of the average is about 1.6%. Last year 1.2. So it has already created the problem of the base effect. Yes. So even if month-on-month is increasing by just 1.2, 1.1 throughout this year, inflation will remain elevated. And factors that I said account for why the monetary policy authority in Ghana should increase it also is applicable to Nigeria. Right. Because they were upbeat even in March. We still saw a level of accretion to foreign reserves, but now in the last few we've been seeing decline. And for Nigeria, so money supply, I talk about 3 factors that affect inflation. It's also the same in Nigeria: money supply, exchange rate, and structural factors. Money supply in Nigeria in the last 10 years, if you look at M2 in terms of money supply, has been increasing by over 12%. Economic growth is just about 2.6%. Same thing what Mette Friedman said, too much money chasing
too few goods.
Too many naira chasing, because this is why you continue to see as the more the government is supporting the economy with naira, what happens if you have excess and you will continue to demand for dollar because your demand has to be met. If local producers are not producing because of the macroeconomic condition, insecurity and all that, they have to buy, which means there will continue to be pressure on what on inflation, on exchange rate, and all of those are creating much of the problem. So I think the best stance would be for the Monetary Policy Authority to adjust policy rate. Yes, they should adjust that upward, right? And there will be other measures to curtail, to address the impact of all of this, on the economy. But we need to actually address that because of what I mentioned earlier, even in terms of interest rate parity, in terms of the risk premium. If you add just general risk premium in terms of our fiscal condition plus election year, that is a risk factor. So that has actually added to the premium. So when you look at all of these factors, MPR, has to go up. In fact, at the last meeting, about 4 members already suggested that when the situations, conditions and those macro indicators were not as bad as this, and in fact, when the last meeting was held, the IMF report was not out then. We've not seen the major revision that we saw in April. So if you put all of those, numbers and indicators together, it's just quite clear that, the Monetary Policy Authority has to go hawkish, from the exchange rate condition, the current account balance. Our current account balance is not as attractive. And how do you even know? It's very easy. Look at the changes to foreign reserves, because the excess of current account balance is what you have in foreign reserves. So as it's declining, even if you don't have recent data, for foreign, you can tell from the foreign. And lastly, PMI. We've not had series of some of those leading indicators that would have told us, where the economy is heading, because a lot of us are quite optimistic and maybe happy with Q4 numbers. But at the last meeting, MPC meeting, they actually pointed at something very instructive in terms of the PMI. It reported that PMI declined from 51 to 50. So that was just
right there.
So we are just at the threshold of a contraction. So whatever happens going forward, and even with what the situation that have deteriorated, we don't even know if PMI has even declined to the contraction region. So it's very important at this time to they have to address all of those.
Omosuyi, it's always great having you. Omosuyi Temitope, investment strategy analyst with AFRINVEST Asset Management LTD. Thank you so much.